Hi, welcome to Market Minute. This is where we analyze the markets looking for opportunities, but most importantly, protecting our downside when we think we need to. The technicals are getting very stretched. We think we're getting to some sort of peak in the market. The market feels like it's going to melt to the upside, but a lot of the technical indicators we look at are pointing to we're starting to top out. We're seeing euphoria in the markets here and there. So this phase could last a while, but we feel like we're putting in a top at this point. Many of the fundamental factors we look at, like valuations, are leading us to believe that we're in the topping out phase. As we discussed last week, if you go back and look at 1987, the dividend discount model that we were using at the firm I was at the time, it turned negative in February, but the market continued to run until around August of that year. So this euphoria stage could last a while. We think it's important to look at the technicals. The technicals are telling us something here. And so, as you know, Meta had a big quarter. Well, Meta had an okay quarter, but the stock went up 20%. So that's unusual. Stocks just don't go up 20% in a day. The world didn't change for Meta all that much. But the market is in that, like I said, that euphoria stage where you're getting excessive moves on kind of minor news events. ARM Holdings is the same kind of way. It went up 60% when they reported. It was just an okay quarter, but it went up 60%. There's a company with ticker symbol BMR, and they announced on Monday morning that they're attending a conference, so they put this out, that they're working with NVIDIA. This is something that we knew a year or two ago when they went public. Nothing new in the press release. The stock went from $2, you can see here, went from $2 to $35 a share. So one of the reasons why we're doing this channel is because we want to educate small investors not to get screwed by these type of actions in stocks. This makes no sense. So stock at 35, when we made the graph is at 24. It closed at 10, and then they're doing a secondary offering. Surprise, surprise, after the close. So whoever bought it way up here, it just lost a lot of money. But it's an interesting company. They have a storage technology that it shrinks the video size down, so you have more capacity in your storage if you're a large company, say like Netflix. So it has an application. It's really early in rolling it out. It has many years before it really becomes significant. They have $3 million in revenues. So we like the concept around the company, but it should never have gone up the way it did. So we see that meme investor coming back into the markets, which is a sign that there's speculation, maybe a lot of speculation in the markets, and we're maybe closer to a top. Over the last 15 weeks, the market is up 14 of those weeks, the S&P. So that's the most since you had to go back way back in the record books to 1972. So that's a long way back. The market's in an overbought condition. Bulls to bears, which is a good contrarian indicator. There's twice as many bulls than there are bears. You do need bulls to have a bull market, but we're at a high point, and like I said, there's a lot of speculation currently going on in the markets. One of the things as a tactical manager that we like to look at is the distance between the market and where the 200-day moving average is. So if the market is too high above the 200-day, there's risk in the overall market. It's more risk than what we're willing to accept, and it can force us to become more defensive. So back in very late July, early August of last year, we got to 12.5%, SP at 12.5% above the 200-day. Now we're at roughly over 12.6% over the 200-day. I've noticed over time, it tends to work fairly well. When you get above 12% above the 200-day, it's a short-term sell indicator. Short-term sell indicators can turn into longer-term sell indicators, so you want to respect that. So the markets are up roughly 23% 3% over the last 12 months. Now, this is something that we developed many, many years ago. Above 20% usually is also a very good sell indicator. So the markets are highly advanced technically. They haven't rolled over yet, but they're flashing big time warning signals. So as we discussed and as we thought, if the market broke above that high that occurred at the beginning of 2022, so if it broke above that level, that was a breakout. But because we were kind of lofty or are lofty in the valuations and many factors like the inverted yield curve and the restrictive policy of the Fed leads us to believe that there's a limited amount of movement to the upside. So at roughly now 21 times earnings, we're clearly in that upper range of PE multiples of the market over its history. So the highest was back in 2000. We were at 24 times projected earnings. Now we're at roughly 21 times projected earnings. Earnings, PE multiples are very high, again, because of the mega cap technology companies. The rest of the market is somewhat reasonable, and there's certain sectors of the market that actually look pretty good. But we thought that there's a limited amount of upside unless we get this massive rotation to the underperforming sectors of the markets. So back down to that now support level where we broke out is about a negative 5% decline. So we would expect that we're probably going to go back to that support level and test it over time. Last week, we bought the Russell 2000 as it fits what we want to do fundamentally, but more importantly, the technicals drove us to that purchase. So the Russell broke down below the 20-day here early in 2024, which gave us kind of a cautionary signal, right? But then broke below the 50-day moving average, that green line, and then broke back above that 50-day moving average and the 20-day moving average, giving us a buy signal. So we think this is a nice trade, unless for whatever reason this rotation in the overall market lasts longer than expected. But we think what the market's doing is because of the level it's at, a high level, overbought condition, still bullish sentiment. Investors are rotating down to those things that have underperformed recently. The Russell 2000 is an index that could move very big once the market becomes comfortable with the overall economy and the Federal Reserve starts cutting interest rates. Now, in terms of wealth management, some thoughts we have here. So we're now 17 months into this inverted yield curve, and we pulled off the Federal Reserve of Cleveland's website some interesting charts. We want to walk through those. So this is the blue line here in this graph is the 1 year lagged. So what happened a year ago, GDP. So it will coincide with the 10-year minus the 3-month spread on the yield curve. So what that's saying is that there's roughly a 1 year lag between what's happening in the yield curve. So there's, as you've probably heard over again, these long and protracted lags between monetary policy and what's happening in the overall economy. So what this is saying is that the economy should be in a downward trend as it's been in this negative mode on the yield curve for 17 months. We think because of all the stimulus that the government has put into the system, that instead of 12 months, it's 24 months before we really see the impact on the economy. That's why we've been believing that sometime in the summer, we will likely enter that recession. So you can see over time, this indicator's worked fairly well. So when on a 12-month lag basis, when you dip into a negative yield curve, the economy does recess. The other indicator that we think is interesting, there's certain levels to this inversion. So in time. And so as you go through this, the Federal Reserve Bank of Cleveland believes that there's a 70% probability of a recession occurring soon, and that we believe you get up into that 30% range, as you can see on this graph, or 40%, you're going to have a recession. So it's highly likely. So we're in that highly likely that we're going to get a recession. There's not a lot of signs of that occurring currently, and we think it's being masked by the government spending. But we are clearly in, there's clear risk that the economy is going to run into a roadblock sometime later this year. So how do you position with this environment? You've got, you want to make money. The markets are hot. You've got speculation going on. It's fun to speculate, right? What do you do in this environment? Well, we think you focus on tactical and or loss averse strategies. If you have a tactical strategy that's loss averse, like the strategies I manage, this is good for this environment. You can still make some money on the upside, but you're not going to get blown up if we roll over into that recession and bear market. Also, we think income-oriented strategies are very timely as interest rates decline next year. So they have to be high-quality income-oriented investments. But as the economy rolls over next year, those income-oriented investments should do really well as interest rates drop. In particular, blue chip stocks we think will do very well as they have growth of the dividends and they're undervalued versus the overall market. So they're not likely to decline much, or they're more likely to go up during this part of the cycle. So we like that as a defensive mechanism to run to, but also as a nice way to make money. So income-oriented stocks, blue chip stocks, loss-averse tactical strategies. Now, we've talked about Viking quite a bit. We love Viking as an investment in the biotech space. In our biotech funds, we got in at $2.40 about 2 years ago, and the stock is over 30 now. So guess what? We're taking profits. We think there's still upside to it. We think maybe the likelihood that they're going to get taken over this year is less than what we anticipated because we see some insiders selling. However, we think it's probably appropriate to take some nice profits in this stock. We have another stock that we want to talk about next week. We're not done buying it yet. It's in the obesity space. Viking has a drug in the obesity space as well. It's different. It hasn't moved. Nobody's really focused on the stock. We think it has big upside potential. So we'll talk about that next week. Thank you very much. Hit like, subscribe. Come to my website, Patrick M. CFA. Sign up for a hard copy to Market Amend. We will send it to you via email every week. Take care.